Hi, and welcome to Chapter 8. In today's chapter, we're going to be talking about stock valuation. Now, stock valuation is important because this is some of the tools and techniques that are going to help us to understand what is the best price for the stock based on its current financial condition, based on its future potential. So what are some methods we can utilize to actually calculate the value of the stock based on all the inputs available. And then we can compare that with the current stock price to see whether or not it would be a good time to buy or sell the stock. So investors constantly struggle with the idea of how much is a stock overpriced, underpriced, or is the stock correctly priced? When we look at the current market price, which is the stock price when you get a quote, and the intrinsic value of the company, the true value of the company. So what makes a stock prediction useful, valuable? Well, of course, the accuracy of the stock prediction was what makes it most valuable. Now, most stocks have the highest percentage of their value based on its future potential. What is the company going to be doing in the next months or years to come? Is sales and profits going to be growing or declining? So this is going to be the biggest factor most investors feel in the current valuation of a stock price. So that would mean that as an investor, we have to develop a methodology for forecasting the company's future performance. And we need to develop a valuation process that's going to help formulate or make a connection to or translate that future performance into what we think the stock price is going to be 3 months, 6 months, or a year from now. So it's all about the future. So if the stock price, if we feel the stock price is going to double in a year, well, we certainly would want to buy the stock now. And many investors would feel that way, and that's what drives up the current price beyond what the current stock is worth, because it's all about betting that we want to own the stock for the future. Now, so valuing a company based on its future performance is a majority of how successful investors predict where the market's going, where the stock prices are going, and where the profits are going to be. So for the current stock valuations, future earnings matter more than past earnings. So the share price is really it's all about the future. So there are plenty of companies that had poor past performance, but were setting themselves up for exceptional future performance. And those companies, their stock prices always went up dramatically before the future financial success appeared. Now, how do we know what's going to happen in the future? So past performance can be helpful about a company's future direction, but it's going to be so much more than that. I mean, we can use historical data to help predict some key variables, but it's not 100% accurate. And there's a lot of factors that we can look at to help us make it a little bit more accurate. Now, one area that we want to look at very closely for valuing a company is going to be its forecasted sales and profits. So there are different things we can use to help forecast the sales. There are assumptions we can make that sales will grow at a certain compounded rate based on past or historical trends. This is a very simplistic approach, but doesn't take into account the changing dynamics of a business. It's assuming that a business is going to stay relatively very stable in its growth of sales and profits. And that's just typically not very true, although managers may try to achieve that. Now, the historical trends in sales, they get adjusted or they change based on how the economy changes, based on how the demand or the industry demographics change, based on the management of the company, how the management steers the company to new products and new markets or new opportunities, and the experience of the managers. So all of these are going to have an effect on the accuracy of forecasting the sales and the profits in the future. But if we go back to that core concept, which is valuing a company based on its future performance. So forecasting net profit margins is where we want to end up. So even though we may forecast higher sales, we need to understand how those sales will translate into net profits. So a company who is increasing its profit margins is more desirable than a company that is not increasing their profit margins. So in some cases, a company may have slower sales growth, but quicker growth or stabilization in profit margins may be more desirable. So we could use the income statement that we talked about in chapter 7 to look a little bit more closely about the types of income and how that's going can be projected forward. So ordinary income, this is what we are going to discover on the income statement. Now, we can convert this to a percentage of sales. And that helps us identify when we make a common size income statement, we're convert everything in relationship to sales. And this gives us a better way of analyzing and identifying changes in profit margins and where it's coming from and what are those causes. Because it's very important to make, if we're going to make a future profit projection, to know where is what is a drag on profits and what's accelerating profits. And this can help management as well as investors get a better understanding of where the stock is moving towards. Okay, so here's a look at a common size income statement. So what we're doing is we're taking sales and we're dividing by sales. So sales divided by sales is 100%. Cost of goods sold divided by sales is 58%. That means for every dollar in sales, we're paying 58 cents in costs, which means that 41 cents is going to be operating profits. So operating profits, this actually should say gross operating profits. This is just looking at the sales dollar less the cost of goods sold. And what makes up the cost of goods sold is direct labor and direct materials. So this is the direct materials that go into a product, the raw materials, and the direct amount of labor dollars that go into making those products. So after, the pure operations of sales and manufacturing, we get direct manufacturing, we get 41 cents as a gross profit. Now, to get to the operating profit, sometimes called EBIT, which is earnings before interest and tax, and this is sometimes called the operating profit. We have to subtract out the selling, general, and administration expense, which is 25% of sales. These are the accounting, marketing, sales, and other professionals that work in the company but don't directly make the products. So that would be this field. Then we'd have depreciation and amortization, which is 4% of sales, and other expenses. So the total operating expenses are 29%. So if we take the 100% less the 41, less the, no, that's not what I want to say. I want to say you take the 41% of the gross profit less the operating expenses, we get to 12% operating profit margin. Then we have interest and tax. So interest on money borrowed and taxes gets us to our net profit margin. So our net profit margin is 7.2% of sales. And this is useful, something we could do when we're comparing different years. Or if we make an assumption that revenues are going to double, we can pretty much follow this percentile format by multiplying the new revenues by each of these percentages to get a better idea where the total numbers are going to be next year. So this common size income statement helps us to get a better understanding of the company. So if we did overlay a factual, this is, say, the percentages from this year, and then we look at the percentages from last year, we could see in what category did things change. Did costs of goods sold increase? Did selling and general administration expenses increase or decrease? So we can kind of pinpoint what is adding to or subtracting from our profits. And that helps us give a better understanding of the profit outlook of a company. So let's go back to valuing a company based on its future performance. So if we're forecasting sales and profits, which the common size income statement can help us do, we can look at this equation, 8.1. So given the sales forecast and the estimate in net profits, we can combine these to arrive at the earnings. So we take the estimated sales for, say, next year, and we multiply it by the expected profit margin. And this will give us our expected earnings for the next year, or whatever year we're trying to calculate. So this is just a basic formula that we could utilize to see where earnings are going. Now, forecasting dividends and prices. So given the corporation's earning forecast that we could calculate, investors are going to need 3 additional pieces of information. An estimate of the future dividends payout ratio. So what is the company's prospective or past payout or future stated payout of dividends? So we can do that to project the firm's current position into the future. So it might be that the firm, for example, a firm might say that whatever our earnings are, we're going to pay out 50% of our earnings in dividends. So if we're forecasting our future earnings, we can actually use that to figure out what our future dividends are. And dividends are a form of cash flow, and we can discount these dividends in a valuation model to figure out what the stock price should be. Number 2 is the number of common shares that will be outstanding over a forecasted period. So usually outstanding shares, they don't change on the percentage terms, they don't change too much, but they change because sometimes companies do issue additional shares, or they may pay out shares to employees. So the amount, or they can also buy back shares. So it's important to know a forecast of the number of outstanding shares. And then we would also want to know, what do we expect the future price to earnings multiple to be? And this is difficult to estimate because this really is a market variable. And as the market's in the more of a bull phase, PE multiples increase versus a bear phase where PE multiples for the entire market tend to decrease. So sort of like a measure of the tide. And sometimes some industries start to take off and their PE multiples naturally increase as well. So it's hard to get an accurate picture of where the PE is going. But there are things we can do to estimate that. So if you want to estimate the PE ratio, things that we should take into account that are going to affect the PE ratio is going to be the growth rate in earnings. Companies with stronger growth rates in earnings have stronger PE multiples because they're more desirable. The more desirable a company is, the higher the PE multiple, because the PE multiple is sort of a measure of how much investors like the company. The more an investor likes a company, the more they buy the stock, the higher the stock price goes. And when you divide that by earnings per share, the higher the PE multiple will go. Number 2 is the general state of the market. Like I was saying before, if the market is in a bull phase and the market tends to be increasing, which means prices overall, stock prices overall are going up the market, we're going to see PE multiples climb. And we could see PE multiples over, say, if you have a 6 to 8 year bull market, you might see PE multiples climb from, PE multiples of 12 on average up to 25. To keep a pretty tight range. It has, PE multiples have gone down much lower to single digits, and they've gone above 30 in market terms of extremes, though. I would say, as a rule, if the PE multiples go below 10 for the market, that's a good buy signal just to buy the general market. If they go above 30, that'd probably be a good signal to sell the market. Those are very rare extremes that may only happen once every 20 years. In some case, 30 years. Okay. Also, getting back to the PE ratio, the amount of debt the company has in its capital structure. So the capital structure is made up of debt and equity. So if the company greatly expands its debt amount in its capital structure, that makes the company more risky because they have more fixed interest payments to make in their debt. So companies that are more risky have lower PEs because investors don't like companies that are risky and they tend to sell their stock. So that's going to affect the PE multiple. Current and projected rates of inflation. When inflation goes up, PE multiples go down. And when inflation goes down, PE multiples tend to go up because the PE multiples are affected by the economy, are affected by the stock market direction. And it is sort of an inverse relationship with inflation. Inflation goes up, above the averages, stock markets tend to react negatively to that, because that usually has an impact on people's ability to purchase and in the economy. The dividend payout ratio. This is how much of the earnings that the company pays out as dividends. So if a company is increasing their dividends, or increasing the amount of dividends they pay out of earnings, that's going to push the stock price higher, because the future cash flows of the company to the investor are going up as well. Okay. So the higher PE multiples are associated with higher earnings growth, and optimistic outlook for the company and the economy, and lower debt. So inflation, like I was saying before, will pull down or put pressure on stock prices and PE multiples to go down. And most companies with high PE ratios have, they typically have lower dividend payouts due to the prospect of earning growth. So let me just explain that. Although it's true, some companies who pay higher dividend payout ratios will push up the stock price and push up the PE multiple. But if the company's in a growth mode, meaning that it's saving most of their monies to reinvest in the company and take advantage of the growth of the industry, that can also push up stock prices and PE prices, because growth stocks increase faster in price than income stocks or value stocks. Okay, so let's look at forecasting dividends and prices. So we'll take a closer look at this dividends issue. Okay, so we want to look at it relative to the price to earnings multiple, or the PE multiple. So we have an average market multiple that I was talking about. So this is if you take all the stocks in a given market, and usually we like to work with the S&P 500, sometimes the Dow Jones Industrial Average, which we talked about in Chapter 3. So if we take all the stocks in the S&P 500 and take all their PE multiples and add them together and divide by 500, we'll get a market average. So this is going to indicate the general state of the market. So we want to get an idea of how aggressive the market is in general for pricing stocks. If everything else being the same, the higher the PE ratio, the more optimistic the stock market is. So as we're tracking the S&P 500 PE multiple, and we get an idea, if we put it on a chart, we get an idea of how things are changing over time. And as this PE multiple starts to drift higher, say if you're looking at it as a monthly average, we see that there's optimism growing that stocks are going to move higher. So this increasing PE ratio, it doesn't necessarily always indicate the length of the bull market or the strength of the bull market, but when they tend to peak, it can be due to very low earnings. So for example, since we're dividing, if during a strong economy, we have strong earnings, so that could naturally pull down PE multiples the stronger the earnings, because it's just a division of stock price by earnings. But typically, the stock prices grow faster than the earnings, so we do see this increase of PE multiples during a bull market. But something weird can happen in a bear market, where suddenly earnings evaporate due to a recession, and stock prices may not follow as quickly, or the stock prices start to move up in anticipation of the next bull market before earnings move up, and then that could raise PE multiples too. So because stock prices the key ingredient is there's a disconnect between stock prices and earnings per share. Stock prices tend to move up before earnings per share move up, and they tend to move down before earnings per share move down, because the stock picking is about future performance. So that could you have to take that into account when you're looking at PE multiples. So PE multiples are confusing. Oops, I fell off the slide there. All right, so PE multiples are confusing. Sometimes can be confusing as a predictor, and that's why experience helps by you just living your life, reviewing the PE multiples, the markets, recessions, or studying the history of the PE market. The PE to the market to recessions to stock price is a good way of getting a better understanding of what is happening. Okay, so here we could see a scale of the PE ratio and the S&P 500 from 1900 to 2019. So if you see here, it's gravitating between a PE of 5 as a low up to PE of 20. So you see for up until say 1991, which is almost it's about 90 years, we see a pretty stable range of the PE multiple between 5 and 20. Now, after 91, we see a peak here. This is probably the dot-com bubble. And then we see a peak here, which would be the bubble before the Great Recession. And you see that how much higher that PE multiple got from the last bubble to the next bubble. Now, currently, we see that the PE multiple is not quite in 2019, not quite in a bubble phase. But if we look past 2019, we're going into 2020, 2021, 2022, 2023. We see that we'll see that certainly developing where the PE multiples will rise before we have another major stock sell-off. It's just typically how things happen. And we can see that a little bit here. This is sort of the 1987 stock market crash. And then we had certainly a peak and then a pullback in 97 of PE multiples. And this has followed a huge correction in the market at that time. So studying the past PE ratios, we can get a better idea maybe what's happening in the future of the stock market. But we can also bring that down to we don't have to look at the whole stock market, but we can look at the relationship to the stock market PE to our stock's PE. And that will help understand the individual stock market price movements. Now, let's look at the price to earnings multiple a little bit more closely. So we could actually develop something that's called a relative PE multiple. And this is how we calculate, we want to evaluate a stock's PE performance relative to the market. And what we're going to do is we're going to divide a stock's PE by the market multiple. So remember, the market multiple refers to the average PE ratio for the market. So we have an example here where a stock has a PE of 35 and the market multiple is 25. So that stock relative to the market would be 1.4. So the higher this relative PE, the higher the stock will be priced in the market. And a relatively high PE multiples can mean, lots of price volatility. So this is just a measure of how far above or below the stock is in relationship to the market. So stocks that typically have PEs higher than the market, these are stocks investors like. Stocks that most likely will have high growth in earnings, high growth in sales. So something about these companies the investors are saying these are going to grow faster than the market. So if you want to see the market's current predictions of which stocks will grow faster than the market, we want to see this relative PE multiple. And it gives us a better idea of a relationship between the stock and the market's PE. Okay, so let's look at dividends for a second. For some stocks, dividends dominate the value of the company and the price of the stock moving forward, because dividends are a form of cash flow and companies are valued based on their cash flow. So if we can forecast a stock's future PE over an anticipated time horizon, we can use the existing PE multiple as a base, and we can adjust up and down based on those expectations. So let's look at forecasting dividends and price. So here's equation 8.2, and we take the future after-tax earnings and we divide it by the number of shares of stock. And that gives us our basic earnings per share. So, and remember that our earnings per share, we have our after-tax earnings divided by book value, multiplied by the book value of the equity times outstanding shares is going to equal the return on investment times the book value per share, which is going to be equal to the earnings per share. So just breaking down the earnings per share there a little bit. Okay, so let's look at the how to estimate the dividends estimated dividends per share. Now, if we take our estimated earnings and times our estimated payout ratio, so the estimated payout ratio is usually something the company would say, we're gonna maintain a steady payout ratio of 50% of earnings. Multiplied by next year's estimated earnings will give us our estimated dividends, which is important for this is a cash flow. So it's basically we're forecasting a cash flow element of the stock. So if we take that, if we go to equation 8.5, so here we're going to estimate earnings per share and use that to help estimate the future value of the stock. Here we have the estimated earnings per share times the PE ratio. So this would give us our stock price. So you see how that one leads to another? By estimating the share price, it's going to give us an idea. We can look at what the current share price is now to where it's going. So the first, to step back for a second, the first thing to do is, what is next year's dividend? So we can estimate that if we know out the payout ratio and we know the earnings estimates for next year's. Then we can multiply the estimated earnings by the PE multiple ratio to get an idea of what the share price was. So it's very powerful. So if we know what we estimate next year's share price, say it's $10 and the current share price is $7, that would be a good instance to buy. Okay. And what it's basically saying here is that the share price is embedded in the capital gains portion of the stock's return. And so the capital gains is, when you buy a stock at 7, you sell it at 10, that's a $3 capital gains. So what we're saying, where do those capital gains come from? Part of those capital gains is from the future cash flows expected in the stock price. Okay. Now, let's talk about developing a forecast for this company, Universal's financial performance. So we're going to look at a couple of tables coming up, 8.2 and 8.3, to look at the historical financial data of this company and a financial forecast for 3 years. So what we're going to be doing is the company's, first we're looking at the revenues and the sales. Revenues and sales are the same thing, but we're going to look at the estimates for those. And that's going to help derive the net profit margin, the total net earnings dollars, number of shares outstanding. We're going to estimate earnings per share, and we're going to by dividing expected earnings by outstanding shares, we're going to project dividends and hopefully project a stock price per share. So let's look at the first table here. So here we're going from 2015 to 2019, and you see that total assets are increasing. Total asset turnover is, for the most part, increasing until 2019. It's pulling back a slight bit. So this just means that assets are turning, as we would expect this. Sales are growing faster than assets, and we see this number growing. In 2019, assets are going to grow faster than sales because we see a pullback here. The growth rate in sales, so here's we see the growth rate, and we see here's the pullback in the growth rate of sales in 2019. Profit margins increasing until 2019. Payout ratio these are expected payout ratios. These are the actual payout ratios, actually, for each of the years, 2019 being 6.6%. The percentage, the price to earnings ratio for the company, and we see that it's moving up nicely in 2019. And then the number of common stock outstanding. So you see that the actual number of common stock outstanding is declining after 2016, and that's because they're probably buying back stock. So how is the growth rate? We have a notation here as far as the growth rate. To find the annual growth rate in sales, divide sales in 1 year by sales in the previous year and subtract 1. So if we took for example, for 2019, if we took the sales revenue, here's the sales actually. So this is the change in assets. This is the change in sales. So sales have been increasing every year moving forward, but assets here, total asset turnover, has been increasing every year except for 2016. And that's why I was saying that the assets grew faster than this year than sales. So if we take 2019 sales minus 2018 sales, divided by 2018 sales. So it's sort of like I always say, new minus old divided by old, and we get the year-over-year change in the sales growth. Okay. Now, let's look at the forecasting statistics. So just note that the forecasted sales statistics are sales from the previous year times 1 plus the growth rate in sales for the forecasted sales. So basically saying if we want to grow the sales for 2020, we're going to take 2019 sales and we're going to multiply by 1 plus 22%, or the growth rate in sales, to get the new sales. So let me make this graphic a little bit bigger so you can see the green area here. Okay, so we're talking about here's the factual actual forecast for 2019, and here's the weighted average in the recent years as just to see a weighted average of sales, net profit, common shares outstanding, payout ratio, and PE multiple. So we move into we want to move into 2020, 21, 22 as a forecasted figure. So we're going to say that growth in sales is going to be 22, 19, and 15%. So we could use that by multiplying 1 plus the growth rate. So 1938 times 1.22, we get 2364. Then we elevate that by 19% and then by 15%. So this is our sales projections. In the net profit margin, we're gonna escalate that net profit margin. We're gonna say it's going 8% to 8.5, and we're gonna keep that steady. The common shares outstanding, we're gonna follow that buyback trend and decline them. And then we have our payout ratio at 6%. So we see our earnings are gonna grow, so our dividend per share is gonna grow. And then also our earnings per share will grow as our profits are growing. Now, if we assume that the PE multiple is going to be steady, we can see where our share price is going to be. So we just multiply our PE ratio by our earnings per share, and we get what we think next year's stock price will be. So we are predicting, if all this comes true, our predictions will say the stock price of $41, if we go back, say pretend we're back in 2019, will become $93 by year 2022. So this is sort of, again, this is our forecasting of where we think the numbers are going to go. Lots can happen in here, though. There could be a devastating medical event worldwide that greatly reduces earnings. Although there could be incredible stimulus spending that greatly increases sales and earnings. So a lot can happen in the world that we don't know. Some of these are sometimes called a black swan. And there's a very famous book written called The Black Swan, which talks about unpredictable events occurring in the world or the stock market that affect prices of stocks greatly that no one had in any of their forecast models. So even though it's nice to forecast, and this could give us, and oftentimes the forecasts are pretty close, sometimes they can be off greatly. Other things we just can't predict. Okay, moving on to the valuation process. So let me reduce this slide a bit so you can see it better. Okay, so let's talk about the valuation process. This is really what is key to being a successful investor. In this process, we're talking about how you can determine the value of a stock. And in this valuation, we're going to have a trade-off between risk and return. So this is, kind of hard for investors to do successfully all the time. And things that might have worked in previous years may not be as effective in future years. So there's a lot to think about here. So investors have to, they got to determine the inputs that are going to value them, that they value the most. And the amount and timing of the future cash flows are going to be extremely important in calculating the required rate of return on investment. So different valuation models can help us determine the rates of return, the intrinsic value of a stock. And we're going to go over, in the remainder of this chapter, we're going to go over these stock valuation process and these very common and classic formulas for valuing stock. So we could find a stock that's a good stock to invest in, meaning it's a worthwhile investment because we think the stock prices are going to move higher if we expect the rates of return equal or exceed the return that the stock is going to give us in relationship to the risk. So the intrinsic value is going to be equal or greater than the stock market price. That's a good stock to buy. So if the intrinsic value is higher than what the current market is pricing the stock, that would be a stock to buy. And then, of course, there's no assurances of outcomes because our projections may not match actual outcomes. Okay. Now, the valuation process, we're going to stop here as part of part 1, and we'll pick up the rest of this lecture in part 2 of chapter 8.